Morning, everyone. Hope you guys are having a great Friday morning so far. We are half an hour before the market is going to open. We did have a import-export report earlier today, but we're not really expecting that to have a big impact on the market. Consumer sentiment will, and that's coming out in an hour. So we'll want to be careful with the opening and all of the data that we see right now that we're about to look at. The picture could change significantly once that report comes out. But let's take a look at how everything looks for now, and then we'll discuss how consumer sentiment report might change that. So our futures are down significantly on the S&P 500. That's about 50 basis points. NASDAQ, not significantly, about quarter of a percentage point. And then the Dow very significantly at about 3/4 of a percentage. So still a big disagreement and big divergence between the Dow and the NASDAQ. And that is really showcasing the emphasis of the FANG stocks and how they're propping up the entire market. We've been talking about that for, I don't know, at least maybe a couple of weeks now. So we got to be very careful with the market right now because it is being propped up. Now, some people would be tempted to say, hey, we're overbought. Okay, we're making all-time highs. Kane's been saying that it's only been held up by a few stocks, and therefore the market is overbought. That would be the wrong way to look at it, especially QQQ. We can see that this is moving up, and it's moving up a lot more than the S&P 500 because those FANG stocks are all in the QQQ, and we only have 100 stocks to dilute them, not 500 stocks to dilute them. So would I say the market is overbought at this point and expect a pullback because of that? I am expecting a pullback, but not because of that. So, and technically, it might seem like that I am slicing too thinly, but the distinction is really important because the way you end up trading is different. So if I say, hey, QQQ is going to pull back, then I'm going to start looking for shorts. And number one, I'd be timing the markets. But even if I was okay with timing the markets, then I start shorting QQQ stocks. And that's not really what I'd want to be doing right now, because if I look at the equal weighted, is that correct? Yeah, equal weighted. When you look at this chart, you wouldn't say it's overbought. The high happened over here. We're at a high over here, and we're just approaching. We wouldn't say it's overbought. Overbought would be way up here. This is flat and waiting to pick a direction. So in a flat market, am I going in on a bunch of shorts? The answer is no. I would, if I pick very carefully, I can go short and then pair it with a long and then be neutral. This equal weighted, like for weeks now, I've been saying neutral, 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 waiting for something, waiting for a stimulus, waiting for a catalyst. Neutral. This is why. If I go long, I want to go short. I don't want to look at the QQQ and say this is overextended. Let's go short. So the equal weighted, that is a very important distinction. If the FANG stocks pull back, will the QQQ pull back? Yes, absolutely. So it might be easy to say, well, Kane, you're just slicing too thinly. And the answer is no, because I will only go short very specific stocks. For example, the FANG stocks, the ones that are propping this up. I won't short just any stock. If the market was going down, if the whole QQQ was going down, I could short anything I wanted and they would all make money. Now is a stock picker's market. I have to pick very, very carefully in order to successfully find the longs and the shorts. So in our programs, you might have noticed in the past week or two, our shorts have been doing really well and our longs have been doing really well. And they are not moving sideways. They are moving directionally. That's because I'm choosing very carefully which stocks I'm going into. I'm picking longs that are not the FANG stocks and they're still going up. And I'm picking shorts that are not the FANG stocks because, and they're continuing to go. And I'm not picking the FANG stocks because right now, picking, trying to pick the top of this NVIDIA is crazy. If I would say, hey, let's go buy long right now, uh, every risk manager in the world would fire. They'd be like, what are you doing? This is, like, we are, there's too much risk here. Your reward to risk ratio, you might be right and it will go up, but the reward to risk ratio here is insane. And then you wouldn't short something that is moving up so strongly either. You can't touch this stock. Institutions, except for very specific institutions, they can't touch this stock right now. So what we're doing is we're choosing very carefully the pairs that we're going into. We're always going into pairs. We're always wanting to maintain neutrality in our portfolios because all the equal weighted indices are telling us to be flat. And then we pick very carefully because there is a disparity between the weighted and the non-weighted. And there's a disparity between the QQQ and the Dow Jones. And so if we pick very carefully, we can get some really, really nice gains. So you always hear me talking about this as a difficult time period, difficult time to trade because I can't just pick any stock and it goes up. But this is where professionals make their money. Is being able to, in these time periods where we're toppy, to be able to pick the ones that are performing and the ones that are underperforming. So I just wanted to make that distinction so you don't get confused and say, hey, we're overextended and we should have a pullback. Yes, that is true, but you don't want to just go short any old stock and expect that they're all going to be able to come back. No, some of them are going to keep on going up, and those are for uh, the ones that, for example, HIMS we just closed. It's still very strong and it's still very, very strong. So maybe this will pull back too, but relative to the market, this is much stronger than the market, so it will pull back less. And so if you go short HIMS, it's not going to pull back as much as the market. You're not going to make nearly as much as if you picked something that was really weak. So that I just want to make that very, very, very clear. The futures, we saw that were down, okay, but not significantly in the Nasdaq, but certainly significantly in the S&P and the Dow. And we're not going to get too excited about that until we see that consumer sentiment report. If we look at our dollar is still moving up. The dollar moving up doesn't necessarily put pressure on bonds because if people are trying to buy US bonds, they have to exchange their currency for US dollars and then they go and buy the bond. So you see demand for both the US dollar and the bond at the same time. So prices will go up in sync. So it doesn't work the same way as say gold where well, actually it might sometimes. It just depends on the market. If people need to exchange for US dollars in order to go into gold, then yes, the dollar and the gold will go up in the same direction. But if they're using existing piles, they already have US dollars and they buy the gold, then there will be the disparity right there. They won't move in the same direction. So a higher dollar then say if that dollar is being bought up because of speculation or because of other reasons, then for example, hedging or currency hedges, then you would see a stronger dollar, but that dollar isn't being used to buy the gold or the treasuries or whatever else. and therefore the stronger dollar can buy more of those, and those things that are priced in the dollars will look weaker. So if they're moving in the same direction, then you have an idea that yes, those dollars are being used to buy that whatever it is that I'm looking at. But if they're moving in opposite directions, then you know that that dollar demand is being caused by something else. So if I start looking at now bonds up. Okay, so it looks like pre-market they're up as well. So it looks like at least some of that dollar demand is going into treasuries because for whatever reason, people still think that we're lowering rates. And the bond guys that I've been talking to, I know a lot of bond guys because I came out of PIMCO. The bond guys that I'm talking to is like, yeah, they're the expectations that rates are going to be lowered. You guys are insane. How can you? Who's running the desk now? As the if we look at the Fed watch, and I've overemphasized this, I think, is the Fed has said out of their mouths, we need more data. And as I already said, one data point is not more data. We need at least 3 data points to be more data. Now, ignoring that, they've also said that one rate cut maybe in 2024. And what we're seeing is rate cut in July, 14%. Fine, not maybe it's not too high, but look at September, 61 plus, so 70 plus percent in September. And then November, we're looking at 84%. December, we're looking at 97%. Because what happens with the Fed is once they start taking action, they take action repeatedly over and over again. They don't go and say, hey, we're going to cut rates by 50 basis points. They've only moved 50 basis points once in history, and that was after COVID. They always move in 25 basis point increments. They say, oh, we'll do 25 basis points this month. We'll do 25 basis points the next month. Or, depending on, they don't do it every single month. So sometimes they skip a month, like they're skipping October. But the next time we'll do another quarter, and then another quarter, and then another quarter. And a year later, we've moved a percentage point or 2 percentage points. It's not that they move a quarter and then they wait and then they wait and then they move another quarter and then they wait. There's no gaps. When they move, they start moving. So what this data is saying is that they're going to cut in September, then they're going to cut in November, and then they're going to cut in December. And the answer is no, I don't think so, because they've already said they're only going to cut once this year. They're not going to be cutting over and over again. So this market on a couple of dimensions is completely out of tune with the Fed. So that is opportunity for us. However, not yet. We got in, we did the 3. We thought that the rationality was going to come back into the markets, and it didn't. Thankfully, we took the expiration that was beyond the July meeting, so we have plenty of time. We can sit and wait. If we have additional capital, we can wait for this market to actually turn around, and so we see a distinct high, and then we can make another entry or a couple of entries. So that by the time we get to a 0% probability in July, then we'll still be profitable. So I'm not worried about being short the TLT at this particular time at all. This is not a 1 or 2 day trade. This is a month and a half, 2 month trade. So we're not worried about this direction whatsoever. The report coming out, consumer sentiment, that's going to be half an hour after the market opens. And this will affect both the bond market and the stock market. So what we're really going to look for is just how good do people feel about these markets? Do they feel super good? or do they feel actually not about the markets, about the economy? Consumer sentiment is the economy, not the market. So we don't want to confuse those two. So do people feel super good about the economy? Hmm. My, I already told you guys based on people that, and this is not in any necessarily a good way for me to gauge because obviously, mostly the people that I'm in touch with are mostly local to me. So it's not necessarily a good representation of all people feel who are experiencing the economy, the representative of the way that all people are experiencing the economy. So, but based on the people that I'm in touch with, people just don't necessarily feel that great about the economy. We're 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 still paying high prices relative to what we were before, and especially if you move from one location to the next, it's easy to get in a bubble and desensitized to the prices that you're paying. But if you, for example, have a vacation spot that you go to every year or every few years, and then you move over and then see what those prices are. So there's a a couple that likes to visit from Germany, my area, and so I used to see them every year and say hello to them. And I hadn't seen them for a few years. And then they showed up this year. They said, oh, well, COVID, we couldn't really come. And now we came back and they said, we are so shocked because everything is at least double the price that it used to be. I was like, ah, there you go. So they are not desensitized. They came from outside place. The last time they experienced it was a few years ago. Now they're back and they're really feeling the inflation. And they're saying everything's double. Their feeling, whether it's true or not, their feeling is that everything has doubled in price. That's 100%. So even if I say we had 4% inflation, 5% inflation, which they're telling us no, it's like 3 point something, but 5% inflation compounded over 4 years is not 100%. It's it's just not. So the price inflation data that we've been receiving is out of touch with what people are experiencing, whether they're really paying that much or it's just a feeling. And and that's what we're talking about in this report. It is a feeling, a consumer sentiment, not people sat down and calculated and said, okay, I have these data points from my credit card statements. I spent $100 on groceries per month when I was in 2020, and now I'm spending $130 per month right now. So that is a 30% growth. No, it's a feeling. This feeling. I feel like I'm paying a whole lot more. I feel like I'm paying double. So this consumer sentiment is going to be based on how people are feeling. And that is, in my opinion, I don't think people are super optimistic. Year on year and month, I don't know if they do month on month. Let me see what happened to, or it was Market Watch, US economy calendar. It was Market Watch. Well, maybe economics. So if I can see the previous report, did they tell me? Here we go. So it looks like monthly. They report monthly. So do I feel better this month than I did last month? I don't think people are that sensitive. I don't think, oh yeah, last month I felt really bad. This month I feel really, I don't think people are that sensitive. So I'm not expecting this number to change too much where we can say, hey, we feel, what is this, 4 points on 69, which is about about 2 to 3%. 4 on 69. Can't do my math right now. Wait, way off. Almost 6%. I feel 6% better about the economy than I did last month. I don't, people aren't that sensitive. They're just like, I feel good, I feel bad. So, I'm not too sure about this. But obviously I'm not in the business of predicting what these reports are going to come out, and I'm not basing any investment decision on it. So therefore, we are going to wait. We're going to wait for 7 o'clock. We're going to see how it's going to go. What is almost for certain, though, is that we'll introduce some volatility. We'll get some directional, and we maybe not, we will swing in the opposite direction and then swing back. But we should get some movement. At least our bars should grow and get bigger after that report. And then we'll see. We'll see what direction we move. Overnight, we traded lower. So do we get enough momentum to break out of that previous all-time high? Or do we get so disappointed that we move down? What I will tell you is that if we move higher, it's probably not going to be a huge amount higher. But if we move lower, especially if we affect the QQQ, then, or sorry, not Q, the Dow Jones, if we're able to come down and break these levels right here, then we're really going to start moving down on the Dow Jones. And the overall markets for the SPY, they won't be able to stand a huge disparity in Dow Jones and the NASDAQ. One will eventually drag on the other. Either the Dow Jones will be dragged upwards, or the QQQ would be dragged downwards. So if we get really strong directional movement in one or the other, then the other should follow. But for now, today, this morning, the sentiment was definitely lower and biased towards the downside today. We could get the bounce. We could move higher than lower, but the problem with that this morning is that we have a pretty significant report happening in just half an hour. So we don't have time for us to go towards the previous close and then revert. So everything is mostly going to be driven by that report. So I wouldn't count on that today. So just be very careful. Don't trade in the first half hour. Maybe don't even trade in the first hour. Let's see what that sentiment report does to the markets and let the markets digest it a little bit before you make any trading decisions today. Okay, so hopefully you got a good, clear picture of what's going on, and I explained a few things in more detail to you guys. We've got about 7 minutes till market opens, so I'll leave it here. And no more weekly market review because of the Father's Day. Because Father's Day, I'm going to be occupied. So Father's Day, so there's no weekly market review. I'm going to see, because normally we don't do Friday at the close, we don't do the after markets. So normally my Friday afternoon is occupied, but if I can clear out my schedule at the market close, I will still be here. I will do a Friday after market review since we have the holiday on Sunday. But I'm not promising. So if you have the time, just show up. And if I'm not there, then I'm not there. If I'm there, we'll have the aftermarket review. Okay. Thanks, guys. Have a wonderful day and maybe entire weekend if I don't see you this afternoon.